Welcome to our journey into the world of personal finance and economic reasoning. Today, we explore how informed decisions shape our financial future. At every turn, we encounter countless choices, yet the reality of limited resources presents the challenge of scarcity, having infinite wants but finite means. This is where economic reasoning aids us in navigating limitations by weighing benefits against costs. At the heart of this reasoning is opportunity cost, a crucial tool for decision-making. Every choice means giving up alternatives, and understanding what we forego leads to wiser financial decisions. Our journey today will show you how mastering these concepts empowers you to evaluate options smartly, leading to healthier financial choices. Prepare yourself to gain knowledge that safeguards your wallet and paves the way to a secure financial future. Let's dive in together. As we venture through personal finance, the principle of scarcity becomes apparent. Limited resources meeting unlimited desires. This concept demands we make challenging choices. Opportunity cost, a powerful tool, urges us to consider what we sacrifice for a chosen path. If you're pondering buying the latest gadget or saving for an emergency fund, each choice has implications. Understanding opportunity cost enlightens the path to wiser choices. These concepts help prioritize where resources can maximize impact, reinforcing long-term goals. Through scarcity and opportunity cost, we see everyday decisions shaping our financial landscape. Evaluating these choices elevates our reasoning and empowers us with insights to navigate personal finance confidently and clearly. What choices will you make today to shape your future? Welcome back to our exploration of personal finance and economic reasoning. Here, we delve into budgeting essentials, a pivotal skill for financial stability. Budgeting is more than tracking expenses. It's a comprehensive financial plan that allocates your income wisely, ensuring every dollar has a purpose. Imagine your income as a pie. Budgeting slices it into segments for essential expenses, savings, and discretionary spending, empowering you to control cash flow and prevent overspending. Setting financial goals is equally crucial. Whether buying a home, preparing for retirement, or saving for a vacation, goals provide direction and motivation, aligning your spending with long-term aspirations. Clear objectives encourage budget adjustments to meet targets, fostering habits that ensure financial well-being. Effective budgeting isn't just expense management, but optimizing savings by understanding interest rates and inflation's influence. Adapting your budget to economic elements maintains purchasing power and maximizes growth potential. In summary, effective budgeting and goal setting are foundational tools for financial stability. By planning for future savings while meeting current needs, you secure a fulfilling financial journey. Stay tuned as we transition to exploring investment costs and benefits next. Investment opportunities are all around us, yet understanding them fully is where informed financial planning starts. Today, we explore investments, examining types and weighing risks and rewards. Stocks offer company ownership and high returns but bring volatility. Bonds provide stable returns but often lower than stocks, as they are essentially loans to governments or corporations. Mutual funds pool money from many investors for a diversified portfolio, spreading risk but involving fees. Balancing risk and reward requires understanding financial goals, risk tolerance, and the time available for growth. Diversifying your portfolio manages risks while aiming for growth. Each investment type has unique characteristics, serving different purposes in a well-rounded financial plan. By evaluating these choices against your financial landscape, you make decisions aligning with long-term objectives. Investments in stocks, bonds, or mutual funds carry both gain potential and risk, making it essential to understand rewards and hidden risks. In personal finance, knowledge guides economic decisions with confidence. As we explore these options, ask yourself, does this align with my goals and risk profile? Imagine standing at crossroads where each path leads somewhere different. This resembles our financial lives. How do you choose the right path? Economic reasoning acts as your guide. Consider buying a new car, not just splurging on luxury or savings. Factors like fuel efficiency and future resale value involve economic reasoning. Choices impact both today's wallet and future well-being. Consider renting versus buying a home. It's beyond immediate affordability. It's about evaluating interest rates and market trends. Each decision resonates through your financial future. Economic reasoning isn't limited to big choices. It's there in everyday decisions too, like choosing between a coffee shop beverage and homebrew. An informed choice today helps achieve future goals, saving for vacations or building a safety net. Weighing costs and benefits is more than managing money, it shapes your life. That's economic reasoning's real power. It converts abstract numbers into tools for wise decisions, matching your values and aspirations. By deploying these principles, you enhance financial well-being, ensuring a future aligning with your dreams. As we conclude our exploration into personal finance and economic reasoning, let's revisit core principles. Understanding scarcity, opportunity cost, and investment evaluations empowers you to make informed choices. Applying these lessons helps navigate budgets and savings confidently. Each financial decision is a chance to reflect on long-term goals and priorities. We hope this journey inspires you to critically assess economic options. If you find value in our discussion, subscribe for more insights on personal finance. Thank you for your attention. Here's to smarter financial decision-making and a prosperous future. Welcome to this comprehensive video on Economics Standard HS.1.1, evaluating how and why people make choices to improve their economic well-being. In this lesson, we'll explore key concepts like scarcity, opportunity cost, needs versus wants, marginal analysis, rational self-interest, and investment risk. By understanding these principles, you'll gain insights into how individuals and societies make decisions in a world of limited resources. Scarcity is the fundamental problem in economics. Our resources, like money, time, and natural resources, are limited, but our wants are endless. This forces individuals and societies to make tough decisions about how to allocate resources. When resources are scarce, every choice involves trade-offs. Scarcity not only affects businesses, but also individuals. For example, if you only have $100 to spend, you must decide whether to buy groceries, pay a bill, or save it for an emergency. That decision involves allocating your limited financial resources. Understanding the difference between needs and wants is critical for sound financial decision-making. Needs are essential for survival, things like food, shelter, and healthcare. Wants, however, are non-essential desires like vacations, luxury items, or the latest tech gadgets. When managing personal finances, people often face choices like prioritizing rent or mortgage payments, a need, over a luxury vacation, a want. Successfully managing your money requires focusing on needs before satisfying wants. By prioritizing needs, you can ensure that your essential expenses are covered before using leftover income for discretionary spending. Opportunity cost is the value of the next best alternative you give up when you make a decision. Every choice comes with a trade-off, and opportunity cost helps us measure what we're sacrificing. Consider this example. Choosing to spend your weekend studying for a test means giving up time with friends. The opportunity cost of studying is the social interaction you missed. But if you ace your exam, the long-term benefits may outweigh the short-term sacrifice. Opportunity cost applies to both personal and business decisions. Companies, for example, face opportunity costs when they decide to invest in research and development instead of expanding their workforce. Marginal analysis helps people weigh the additional benefits and costs of a decision. It's not about the total cost, but about comparing the extra benefit gained from one more unit of something against its additional cost. Imagine you're deciding whether to work overtime. The marginal benefit is the extra income you'll earn, but the marginal cost is the free time you'll lose. If the benefit of extra pay outweighs the loss of leisure, you might choose to work the extra hours. Marginal analysis helps businesses too. Companies use it to decide whether to produce one more unit of a product, considering whether the revenue earned from that extra unit justifies the cost of producing it. Rational self-interest is a key principle of economics. People make choices that they believe will improve their own well-being, whether it's financial security, career advancement, or personal satisfaction. Interestingly, individuals acting in their own self-interest can also unintentionally benefit society, a concept known as the invisible hand. Entrepreneurs create new products or services because they want to earn profits. However, their efforts also create jobs and improve consumer choices, benefiting the economy as a whole. Rational self-interest drives innovation and economic growth, demonstrating that personal financial choices can lead to broader societal benefits. Investing in the stock market can offer significant growth opportunities, but it comes with risks. The stock market is volatile, meaning prices can fluctuate rapidly. This is why understanding risk tolerance is crucial when making investment decisions. Those with a higher risk tolerance might invest heavily in stocks, while more conservative investors might choose bonds or savings accounts. During the 2008 financial crisis, many investors lost money due to market volatility. However, those who diversified their portfolios, investing in a mix of stocks, bonds, and other assets, were better able to weather the downturn. Diversification spreads risk across different investments, reducing the likelihood of significant losses. Remember, the stock market can provide rewards, but it's essential to understand the risks and plan accordingly. In this video, we've explored foundational economic concepts like scarcity, needs versus wants, opportunity cost, marginal analysis, rational self-interest, and investment risk. These principles guide both personal and societal decision-making in a world of limited resources. Understanding these concepts can help you make more informed financial choices, whether you're managing your personal budget or investing in the stock market. Think about how these principles apply to your own life. What trade-offs are you willing to make to improve your economic well-being? Welcome to our video on Economic Standard HS.E1.3, evaluating the costs and benefits of using credit. In this lesson, we'll explore what credit is, how it impacts your financial decisions, and how credit scores can shape your financial future. Understanding these concepts will help you make informed choices when borrowing money. Credit is the ability to borrow money or access goods and services with the understanding that you'll pay back the money later. When used responsibly, credit can help you build wealth, but it also comes with costs, mainly interest and fees. For example, using a credit card to buy a laptop allows you to spread out payments over time. But if you don't pay off the balance in full, you'll have to pay interest on the amount you owe. The main costs of using credit come in the form of interest rates and fees. Interest is the cost of borrowing money, and it can add up quickly if you don't pay off your balance in full. Late fees, annual fees, and penalty interest rates can also increase the cost of using credit. Let's say you charge $1,000 to a credit card with a 20% interest rate and only make the minimum payment. Over time, you'll end up paying much more than $1,000 because of interest charges. It's important to be aware of the true cost of credit and avoid carrying balances from month to month whenever possible. Despite the costs, credit can also provide several benefits. It allows you to make large purchases, such as a car or home, without needing to have all the money up front. Credit can also help you build a credit history, which is important for future financial opportunities, like getting approved for loans with better interest rates. Using a credit card responsibly, paying off balances in full and on time, can improve your credit score, which helps you qualify for lower interest rates on loans and mortgages. When used wisely, credit can help you achieve your financial goals, such as buying a home or financing a college education. A credit score is a number that reflects your creditworthiness, or how likely you are to repay debt. Lenders use your credit score to determine whether to approve you for loans, and your score also affects the interest rate you'll pay. The higher your credit score, the more likely you are to get better terms on loans. Someone with a credit score of 750 might qualify for a mortgage with a low interest rate, while someone with a score of 600 could be offered a higher rate, increasing the overall cost of the loan. Your credit score is affected by several factors, including your payment history, the amount of debt you owe, and how long you've had credit. To maintain a good credit score, pay your bills on time, keep your credit balances low, and avoid applying for too much credit at once. Before using credit, it's important to weigh the costs and benefits. On one hand, credit gives you access to funds and helps you build your credit score. On the other hand, it comes with costs like interest and fees, which can add up if you're not careful. For example, using credit to finance a college education could lead to better job opportunities and higher income in the long run. But taking on too much debt without a plan to repay it could lead to financial stress. Always consider your financial goals and your ability to repay what you borrow before taking on new debt. Responsible credit use can help you achieve financial success, while irresponsible use can lead to long-term financial problems. In this video, we've evaluated the costs and benefits of using credit. We've discussed how interest rates, fees, and credit scores impact your financial decisions. By understanding how credit works and using it wisely, you can build a strong financial future. Remember, credit can be a powerful financial tool, but it must be used responsibly. What credit decisions will you make to improve your financial future?
Welcome to our video on Economic Standard HS.E1.4, comparing the costs and benefits of different types of investments. In this lesson, we'll explore various investment options, including stocks, bonds, mutual funds, and real estate. Understanding the advantages and disadvantages of each will help you make more informed financial decisions. Stocks are shares of ownership in a company. When you buy stock, you're essentially buying a small piece of that company. Stocks offer high potential rewards, as their value can increase significantly if the company performs well. However, stocks are also the most volatile investment. Prices can rise and fall quickly, and there's a risk of losing your entire investment if the company performs poorly. Let's consider someone who invests in a popular tech company. While the stock price might soar during times of innovation, it can also drop during economic downturns or market corrections. The key benefit of stocks is the potential for significant growth, but the cost is the high level of risk. Stocks are best suited for individuals with a high risk tolerance. Bonds are essentially loans that you give to a government or corporation in exchange for regular interest payments. Bonds are more stable than stocks and provide steady income, making them less risky. However, their returns are generally lower than stocks, meaning they're more suited to conservative investors who prioritize stability. For example, U.S. Treasury bonds offer a guaranteed return over a set period, but the return is lower compared to what you might earn from a successful stock investment. The benefit of bonds is their stability and steady income. The downside is that they typically don't offer the same high returns as stocks. Mutual funds allow you to pool your money with other investors to buy a variety of assets, such as stocks, bonds, or other securities. Mutual funds are professionally managed, and their key advantage is diversification, spreading your investment across different assets to reduce risk. However, mutual funds often come with management fees, which can eat into your profits. Imagine investing in a mutual fund that includes a mix of tech stocks, government bonds, and real estate. The variety of assets helps balance the risk, providing some protection if one sector underperforms. The benefit of mutual funds is reduced risk through diversification, but the cost includes management fees that may lower your overall returns. Real estate involves purchasing property, such as land, homes, or commercial buildings, as an investment. Real estate has the potential for long-term gains through property appreciation, and it can also provide income if you rent out the property. However, real estate requires a significant upfront investment, and there are ongoing costs for maintenance and property management. Consider someone who buys a house and rents it out. Over time, the value of the property may increase, and they'll earn rental income. However, if property values drop, or if maintenance costs rise, they could lose money. The benefit of real estate is the potential for long-term appreciation and income, but the costs include high initial investment and ongoing expenses. Let's compare the risk and return of these four investment options. Stocks offer the highest potential returns but come with the greatest risk. Bonds provide steady income with lower risk but offer smaller returns. Mutual funds allow for diversified investments, balancing risk and return, while real estate offers long-term gains but requires significant upfront investment. The right investment for you depends on your financial goals, risk tolerance, and investment time horizon. If you're comfortable with risk and seeking high returns, stocks may be for you. If stability is more important, bonds or mutual funds might be a better fit. And if you're interested in tangible assets, real estate could be the way to go. In this video, we've compared the costs and benefits of stocks, bonds, mutual funds, and real estate. Each investment type has its own advantages and disadvantages, and choosing the right one depends on your personal financial situation and goals. Making informed investment decisions is key to building your financial future. Take the time to evaluate your options and remember that diversification can help you manage risk. What's your next investment choice?
Welcome to this video on Economic Standard HS.E1.5, evaluating the ways insurance can minimize personal financial risk. In this video, we'll explore how insurance works, the different types of insurance, and how it protects individuals from unexpected financial losses. Understanding insurance is key to managing personal financial risks and planning for the future. Insurance is a financial product that provides protection against financial losses in exchange for regular payments called premiums. When an insured event occurs, such as an accident, illness, or damage, insurance helps cover the costs, reducing the financial burden on individuals. For example, if you have car insurance and are involved in an accident, your insurance can help pay for the repairs to your vehicle or cover the costs of medical bills. Insurance is designed to protect you from significant financial risks that could otherwise create major financial setbacks. There are many types of insurance, each designed to cover different risks. Some of the most common types include health insurance, car insurance, home insurance, and life insurance. Each of these provides protection against specific types of financial risks. Health insurance helps cover medical expenses, while home insurance protects against damage to your property from events like fires or floods. Life insurance provides financial support to your family in the event of your death. Each type of insurance plays a role in protecting against specific financial risks, helping you avoid large out-of-pocket expenses. Insurance reduces personal financial risk by transferring the cost of potential financial losses from you to the insurance company. In exchange for paying a premium, the insurance company agrees to cover some or all of the costs related to certain events. For example, without health insurance, a major medical emergency could result in thousands of dollars in medical bills. With insurance, the cost is shared between you and the insurer, reducing the financial impact. This risk-sharing arrangement helps you manage unpredictable events, so you're not forced to cover the full cost on your own. When purchasing insurance, two key components are the premium and the deductible. The premium is the regular payment you make to the insurance company to maintain coverage, while the deductible is the amount you pay out of pocket before your insurance kicks in. Let's say your car insurance policy has a $500 deductible. If you're in an accident and the repair costs are $2,000, you'll pay the first $500 and your insurance will cover the remaining $1,500. Choosing the right balance between your premium and deductible depends on your financial situation and risk tolerance. Higher deductibles often mean lower premiums, but it also means you'll pay more out of pocket in the event of a claim. Having insurance is an important part of financial planning. Without it, unexpected events like accidents, medical emergencies, or natural disasters could lead to significant financial losses. Insurance provides peace of mind by knowing that you're protected from the high costs of these events. For example, homeowners with home insurance are better equipped to handle the costs of repairing or rebuilding their homes after a fire or storm. Without insurance, they might struggle to recover from such a loss. Insurance not only minimizes financial risk, but also helps individuals and families recover more quickly from setbacks and avoid financial hardship. In this video, we've explored how insurance helps minimize personal financial risk. Whether it's health insurance, car insurance, or life insurance, these financial products protect you from the high costs of unexpected events. Remember, insurance is an essential tool for managing personal financial risk and protecting yourself from life's uncertainties. How can insurance help protect your financial future?
Welcome to this video on Economic Standard HS.E 2.2, analyzing how incentives influence economic choices for individuals, institutions, and societies. Incentives, whether they come in the form of rewards or penalties, play a critical role in the decision-making process. In this video, we'll explore how individuals, businesses, and governments respond to these incentives and make economic choices. Incentives strongly influence individual choices. People are motivated by positive incentives, such as discounts, rewards, or tax benefits, and negative incentives, like fines or penalties. These incentives shape how we spend money, save, and even work. Take a grocery store offering a 10% discount on bulk purchases. This positive incentive encourages shoppers to buy more than they initially planned, as they see it as a way to save money. On the other hand, negative incentives, like late fees, encourage individuals to pay bills on time to avoid extra charges. Businesses and institutions are also driven by incentives. Companies respond to financial incentives like tax breaks or subsidies, which influence their decisions about where to build factories or what products to offer. These incentives can have a ripple effect on jobs, prices, and innovation. A local government might offer tax incentives to attract a large tech company to build its headquarters in the area. The company's decision to accept these incentives could lead to job creation and economic growth for the community. However, businesses must also weigh the costs and benefits of these incentives, as they come with conditions or long-term commitments. Governments use incentives to influence societal choices and guide the economy. Public policies often include incentives to encourage or discourage certain behaviors. For example, governments offer tax deductions for energy-efficient home improvements, incentivizing homeowners to invest in renewable energy sources. Consider a government that offers tax credits for purchasing electric vehicles. This incentive encourages citizens to choose eco-friendly cars, reducing carbon emissions and promoting environmental sustainability. At the same time, governments can impose negative incentives, such as fines for polluting or penalties for non-compliance with regulations, to discourage harmful behaviors. Incentives, whether positive or negative, have a powerful effect on decision-making. For individuals, incentives can alter spending habits, savings rates, and investment decisions. For businesses, incentives influence production, hiring, and innovation. And for governments, incentives can drive policy changes that impact society at large. For example, during a recession, the government might lower interest rates as a positive incentive to encourage borrowing and spending, stimulating the economy. Meanwhile, a penalty for polluting can act as a negative incentive, pushing businesses to adopt cleaner technologies. Whether it's a tax cut that encourages businesses to invest, or a fine that discourages pollution, incentives play a crucial role in shaping the choices made by individuals, businesses, and governments. In this video, we've explored how incentives influence the economic choices of individuals, institutions, and societies. From discounts that drive consumer behavior to tax breaks that encourage business investment, incentives are a powerful tool that shapes economic decisions. Remember, incentives, both positive and negative, are everywhere in our economy, guiding the decisions we make. How do incentives influence your own choices?
Welcome to this video on Economic Standard HSE 2.3, using cost-benefit analysis and marginal analysis to evaluate economic issues. In this video, we'll explore how individuals, businesses, and governments use these tools to make informed decisions. Understanding cost-benefit and marginal analysis helps us weigh the pros and cons of different choices. Cost-benefit analysis is a decision-making tool used to compare the costs and benefits of an action. It helps individuals and organizations determine whether a decision will bring more value than it costs. The goal is to choose the option where the benefits outweigh the costs. Imagine you're deciding whether to invest in a new laptop for school. The cost includes the price of the laptop, but the benefits include better performance and higher productivity, which could lead to better grades. If the benefits, such as improved grades and efficiency, outweigh the cost, then it makes sense to go ahead with the purchase. Businesses use cost-benefit analysis to determine whether to move forward with projects, investments, or hiring decisions. This tool helps companies maximize profits by focusing on actions that offer the greatest net benefit. A company might evaluate whether to invest in new technology. The cost would include the upfront investment in equipment and training, while the benefits could be improved efficiency and reduced operating costs. If the analysis shows that the long-term benefits outweigh the short-term costs, the company is likely to proceed with the investment. Marginal analysis is used to evaluate the additional benefits and costs of a decision. It focuses on the impact of one more unit of something, such as one extra hour of work, or one additional unit of production. Marginal analysis helps us make decisions based on the incremental changes in costs and benefits. Let's say you're deciding whether to work an extra hour. The marginal benefit is the additional money you'll earn, while the marginal cost is the time you could have spent relaxing or studying. If the extra income is worth more to you than the lost free time, it makes sense to work the extra hour. Businesses use marginal analysis to decide whether to produce one more unit of a product, hire one more employee, or invest more resources in marketing. Cost-benefit and marginal analysis are tools that individuals, businesses, and governments use to evaluate real-world economic issues. For example, governments use cost-benefit analysis when deciding whether to fund public projects, such as building new infrastructure or implementing healthcare programs. A government might evaluate whether to build a new highway. The costs include construction expenses and environmental impacts, while the benefits could include reduced traffic and economic growth in the area. Similarly, marginal analysis can be applied to policy decisions, such as determining whether raising taxes by 1% will generate enough additional revenue without causing significant harm to the economy. Cost-benefit and marginal analysis are essential tools in decision-making. Whether you're an individual deciding whether to work overtime, a business evaluating a new project, or a government planning public policy, these tools help ensure that decisions are made rationally and efficiently. A company might use marginal analysis to decide whether to produce an extra 100 units of a product. The marginal cost of producing those additional units must be lower than the additional revenue generated to make it a worthwhile decision. By carefully analyzing the additional costs and benefits, companies can maximize profits while minimizing waste. In this video, we've explored how cost-benefit and marginal analysis are used to evaluate economic issues. Whether you're making personal, business, or governmental decisions, these tools are critical for making informed choices. Remember, analyzing the costs and benefits of each choice helps you make better financial decisions and avoid unnecessary risks. How will you apply cost-benefit and marginal analysis in your life?